turn our attention now to loans. So loans are the one type of financial aid that must be paid back. That is money that is borrowed. So you can use a loan to pay for tuition, books, housing, and other types of things that are needed for attending college. But once again, they must be paid back. And this typically happens after a student leaves school, if a student drops out, or if the student's course load drops below half time. There are several different types of loans, and it's important to know the difference between them. They are very, very different. They have different pros and cons. So we'll go over each one of these types of loans separately. So we're going to start with the federal student loan, which is money borrowed from the federal government. In order to qualify for a federal loan, you must fill out the free application for federal student aid, or FAFSA. We discussed the FAFSA earlier in the course. It's in the last module. So to learn more about that, be sure that you have watched that module. So some things that are important to know about federal loans: they have financial limits. So you can't just borrow a large amount of money if you take out a federal loan. In fact, the first year, the freshman year, a student is limited to a maximum of $5,500. So the student can then borrow $5,500 for the first year. The second year, when the student is a sophomore, the amount goes up to $6,500. And then each year after that, the student can borrow up to $7,500. There is a maximum amount that the student can borrow from the federal government, and that is $31,000. So a federal loan is typically divided into two parts: the subsidized loan and an unsubsidized loan. So the subsidized loan has interest that's paid by the government while the student is still in school. So the student doesn't have interest accruing while they are working hard on their studies. And typically the government keeps paying this interest until the student graduates, the student drops out of school for whatever reason, or the student drops below half-time status. There's also some other situations where they would continue on paying the interest. There is a 6-month grace period. So after the student has left school, they have 6 months to get a job to figure out how they're going to pay back that loan. And then there are special situations such as graduate school, unemployment, economic hardships, Peace Corps, and certain military services where a student would not be required to pay on the interest. So the loan basically waits for that student. It does not get bigger. It will still be there, but it does not grow. So qualifying for a subsidized loan will depend a lot upon the student's need. It is not automatic. So when the student fills out the FAFSA, the calculation is made and the government decides how much the student should have in a subsidized loan versus an unsubsidized loan. Now, the second type of direct loan that is made by the federal government is the unsubsidized loan. And what makes this different is that the minute the student takes out the loan, it starts to gain interest. And so what that means is that the student might start with a certain amount of loan, but when they actually leave college, the amount they owe is larger than the amount that they actually borrowed. With both of these types of direct loans, the subsidized and the unsubsidized loan, the repayment period starts 6 months after the student leaves school, whether that be graduation, whether that be the student needing to drop out, or the student drops below half-time. So there is a grace period, and with the subsidized loan, the interest does not accrue during this grace period, but with the unsubsidized loan, the interest does. So once a student leaves school, they enter repayment. And this typically happens, as mentioned before, when a student graduates, when a student drops below half-time, or a student drops out for whatever reason. Repayment can also be delayed if the student enters graduate school and in other circumstances. A loan is typically repaid over a 10-year period of time after the student goes through their grace period. But there are also other methods of repayment at this time. You can have a graduated payment plan where the amount starts low but goes up. There's also a payment plan that is income-based, where they base the amount that is repaid on a student's current income. When the student is ready to pay back their loan, they will go through a counseling process, an online counseling process that will give them all the options that is needed to understand the repayment, the interest rate, and everything else that goes with having a loan. So that will be explained to the student upon their finishing of school. Now, while direct student loan, the federal loan, has limitations, there is a second type of loan that can be given to the student, and that is a private loan. And this is done through a private lender, a bank, somebody that is not attached to the federal government. Now, this is a little different because a student can borrow significantly more through a private loan than they can through a federal loan. And this can get a little bit dangerous because the limitations, they don't protect the student like they do with the federal loan. And this is where students can really get into trouble. So it's really important to understand that a private loan does not have the same protections that a federal loan does. A private loan is also different in that the interest rate may vary. Now, the interest rate for a federal loan is set by the government. It is one interest rate. But a private loan is set by the lender, and the interest rate could vary depending upon credit score. And so you may get a very good interest rate, or you may get a very, very high interest rate. You also may get a variable interest rate. And so you can see that this is a bit different. It's a little bit more dangerous, and it is the last resort. This is the type of loan you want to be very careful of if you are going to take out a loan to pay for college. A private loan may also be problematic because the student may not actually have credit yet. And often a private loan requires one or more cosigners. And this could be kind of dangerous in another way because if something should happen to one of the cosigners, the loan may come due. So if grandma decides to sign for a loan for her grandson so that he can attend an expensive college, and something happens to grandma, her grandson may suddenly find that the lender is asking for the money back right now, all at once. This also can come true in the opposite direction. If something should happen to the student, the cosigner may suddenly find that they owe everything on the loan at once as well. The last type of loan I want to go over is the Parent Plus loan. And this is a loan that is taken by the parent. And the loan amount can be as much as the cost of school, but no more. This loan can never be moved to the student's name. So once the parent takes it out, it is a loan that belongs to the parent. And the student, while they might agree to pay for it earlier on, they're under no legal obligation to do so. So this is something that a parent needs to be very, very aware of. It is their loan, and it belongs to them, and it is the responsibility of them. Now, the parent usually is asked to start repayment on the loan immediately, but they can ask for a deferral for the loan until the student graduates. However, like the unsubsidized loan, the interest will immediately start to accrue. So it is really important to understand that this is a loan that will possibly be bigger than what was originally borrowed because of the interest that is accruing if the loan is deferred. So this is our section on loans. We talked about the direct student loan, both the unsubsidized and the subsidized portion. We also talked about the private loan, as well as a Parent Plus loan. When the student starts school and decides to take out a loan, or if the parent takes out a loan, they will go through a counseling process online so that they can get the information that they need. And when they are complete, they will also go through a repayment counseling process. So all the information should be there in front of the student and the parents so that they know exactly what is expected of them. But I have seen too many times the students being surprised at the amount that they owe. So a loan is something that you definitely want to think about before you make that decision on that possibility for paying for college.